Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. My next guest is Dennis Bethel. Dennis is a 20-year veteran in the real estate investing industry. He invests primarily in multifamily. So he does acquisitions, market development, and capital development. He's successfully raised over $200 million in capital and facilitated over $900 million in multifamily transactions. Dennis, thank you so much for being here. I really appreciate it.
Hey, Vincent, great to be here. Thank you.
Oh, you're welcome. I appreciate you taking time out of your busy schedule. I'm sure you've got some really exciting things that you're working on, but you've got a pretty interesting background. So you're by trade, you're a medical physician. And you spent some like 18 years in the medical world and somehow found yourself in real estate. How did that happen?
Well, I started out as an emergency room physician, and I worked in that initially in the Central California area, busy emergency room. And then I went out to New Mexico, and I started working in New Mexico. And I think, like a lot of people, around that time I read Rich Dad Poor Dad, and that opened my eyes to real estate. And it just so happened that my father-in-law was buying quads in Orange County, California at that time. And, I wasn't sophisticated in real estate yet, but I'm seeing him buy a property, rehab it, and then resell it a year or two later, making a $200,000, $300,000 profit. And I'm thinking, wow, I want to do that. Unfortunately, that was my lesson into markets matter, because I'm buying fourplexes in Albuquerque, New Mexico, which is a great city, but not similar market to Orange County, California when it comes to real estate. So I started buying fourplexes. I had a triplex. I even had a single family home, and I really cut my teeth in the residential space. It was good to me, but I also ran into some things that really frustrated me. One, that there was no economies of scale in that space. Two, it seemed like because I leveraged those properties and I financed them, it seemed like I was always one vacancy away from negative cash flow. So if somebody moved out, I was scrambling to get somebody in there so that I didn't have to write a personal check to cover the mortgage. And also, I was running up against, because I was getting full recourse lending, and I had to personally guarantee those loans. I was running into debt to income ratios and maxing out on the loans. And at some point I was going to have to start looking at owner financing or owning them free and clear. And so it started to get fairly complex. Well, around that time, I started to feel burnout in emergency medicine. And emergency medicine is the specialty with the highest rate of burnout. And so I'm thinking to myself, as exciting and as interesting as I found that to be when I was younger, I'm getting older. I'm married now. I have kids. I don't like staying up all night. I wanted to find something new to do. And so with that pressure of burning out, and then we found out that unfortunately my wife has the BRCA genetic mutation, the breast cancer gene. So she has a high percentage of lifelong of getting breast cancer and ovarian cancer. And at that time, Obamacare hadn't been passed yet. So there was still no guarantee that you couldn't be discriminated based on pre-existing condition. So I'm thinking to myself, how am I going to take care of my family? How am I going to make sure that they're going to be okay? And cut back on the number of shifts I'm doing in the emergency room. And that's when I started looking at commercial real estate, and primarily multifamily real estate. One of the ER doctors that I worked with in Gallup, New Mexico, came to me one day and said, hey, there's a 72-unit student housing property, one block from the University of New Mexico. And I know you have a lot of real estate. Would you like to get in that? And I said, well, I'd like to look at it at least. Could you show me the financials? Can I go drive the property? I'd be interested in learning more about it. So it took me a couple weeks to go through it and everything, but it made a lot of sense. And so I invested in it, and it was like, wow, we might have 10% vacancy in that property, and we were still getting checks on a quarterly basis. And I wasn't managing the property at that time. There was some issues, and the doctors are pretty confident. And so my friend thought he could manage the property, and he really didn't have a real estate background at the time either. So for somebody who was more than a novice but wasn't a professional to manage that property and produce positive cash flow on a regular basis was really eye-opening. But it also made me think, well, what if we upped our game and made this more professional, and how could we turn this into more of a business than 4 or 5 ER docs pooling their money together and buying a 72-unit property? So I took my profits from that property, and then from that point on, it was like, hey, I'm going to be investing in multifamily in large cities, in markets that really had great population growth, great economies, a lot of jobs, diversity of jobs, all the different metrics that are really important to making money in this business.
Yeah, that's interesting. With your background there, you got a unique perspective on what the medical community is going through. And I read somewhere that you had colleagues that just couldn't afford to retire despite having, long medical careers and, potentially making good amounts of money. Um, what was it that changed your perspective on that? Was it just like your own situation, or were you looking outward as well and seeing all these people that you knew that just didn't, there was some good money being made, but it wasn't really turning anything meaningful for wealth creation?
Yeah, I started this journey for myself and for my family, but it quickly became apparent to me that there's a lot of physicians out there in similar situations. Um, and, we're investing in what they were investing in, but really didn't want to get into real estate. And, the thing I'd hear all the time was, I don't want to become a landlord. And, and that's completely understandable. I mean, physicians work long hours and all the rest of that. But what I started to realize is, I've never worked in an emergency room that was fully staffed. There's just shortages in medicine, a lot of burnout, a lot of challenges. I used to be the doctor-patient relationship was sacrosanct, but now, there's so many third parties that have inserted themselves into that relationship. Doctors are working for hospitals, they're working for private equity, and it's really strained their satisfaction in why they went into medicine. And so I'm working with a great group in Fresno, a lot of really skilled physicians, but we're all working way more shifts than we want to work. And finally, one day I went to the meeting and I said, "Hey, listen, guys, I'm working too many shifts. I want to be home with my family, and I don't need the money. And so we need to get some locums in here. We need to get some traveling physicians in here to do some of these shifts." And at that time they had the contract with the hospital, and they're like, "No, when you work with locums, you don't know what you're going to get, and we're not going to lose this contract. So until we get we get full staffed, when we get full staffed, until then you do as many shifts as the rest of us do. We're just going to suck it up." And I said, "Okay, then I'm out." And they looked at me and they said, "What do you mean you're out? How can you be out? You're relatively young compared to a lot of us. You have small kids that you got to put through college. You need the money." I said, "No, I don't need the money. I'm investing in real estate." And boy, I mean, that meeting changed from "we need doctors" to "how the hell are you doing this?" And it became really evident that a lot of doctors didn't know about this. It also became evident that they were 100% dependent on their own earned income, and they weren't developing passive streams outside of medicine. Maybe it wouldn't cover everything they needed, but maybe it'd cover 20% or 40% or whatever. It would give them some breathing room to work less shifts or to do other things. And that was really lacking in the space at the time. That was probably, and so around 2012, I continued to do the work that I was doing for myself and my family, but then I opened up my website just to share with others. We really had nothing to offer anybody as far as terms of sales or anything like that, but just to offer the education and the information of what I was doing so that people could see what I was doing, other physicians could see what I was doing and learn from it.
Yeah, it's funny because you mentioned they said they didn't want to be a landlord, and it's just like people's knee-jerk reaction to it. Um, but really, it's like they didn't know. They didn't know what they didn't know, right? Which
Right.
creates like this blind spot, but that's why it's so important. I think this whole concept of financial literacy is so important because even if they
Absolutely.
realize that there's a problem and they figure out that okay, there's a different solution than just putting money in the stock market. Now you have to open up their eyes to okay, here's the world of commercial real estate. Here's multifamily. Here's how you can earn passive income, backed by real estate assets. And that's for a lot of people has never been taught before. They certainly don't teach it in school. They don't teach it in
No.
college. There is
Right.
no world besides the world that we live in now where any sort of education is out there for people unless they're trying to sell you some expensive course, right? Like, some guru, selling some
Right.
$30,000 course or an investment club, right? Where there's huge fees. So how did
Right.
you get into being an educator? Because now you've got Nest Egg RX, which is, I guess, the branding around this concept of educating professionals and being able to provide them information that can really help them change their
Yeah.
their financial futures.
Well, like I said, I opened Nest Egg RX in 2012 just to share with what I was doing. And as I was going along, I was started to do market development, and I started to do deal development. So I started looking into markets and I started underwriting properties, but I didn't have an investor base to invest with. So I began partnering with a commercial real estate firm to look into markets that they weren't in currently, and to bring them deals. And so that's how that partnership started. Well, during that partnership, other physicians and people from Nest Egg RX would ask me, "Well, this is great. I really like this information. Do you have any properties we can invest in?" So I would refer them to the company that I was working with, and that started to develop uh, unintentionally, and eventually we got to the point where I uh, became an employee of the company, became a principal of the company. And I've spent over 13 years with that company before striking out on my own last year.
I love it. No, it's such a great angle, right? Because you're solving a real problem here. And it isn't a problem you just went out and created. Like these are real problems that you as a medical professional experienced and all your colleagues were experiencing it as well. So it's such a good niche, right? Because in a lot of people's circles, most people just don't have the liquidity or the financial resources to even look at a multifamily or commercial deal because most of these are 25, 50, $100,000 minimums,
Right,
and the average American just doesn't have that kind of liquidity.
right, right. Yeah, and I know that some of these other companies have decreased their minimums, which is helpful. I mean, even the fact that you have to be an accredited investor to invest in multifamily, these are all rules that all of us have to follow. But in reality, the more you understand the space, the more you understand that this type of investing can help a lot of people, accredited or not. Uh,
Hmm.
but nevertheless, you still have to follow the rules that are set before you.
Right. So at one point, did you decide to go legit, right? Where you went from just maybe just having sort of a collection of people who would form an LLC and invest in a project to actually starting a fund where you had to have all the SEC compliance and everything that goes with it.
Well, we like you're absolutely right. We started just on individual deals, and they might be 80 to 150, we would get and then we would get the capital to start flowing where it's like, hey, we could do 2 of these deals. Now we got so much capital, or maybe what we should do is go with something bigger. We should go 250, 300. And then it started to become apparent the best path forward to start a fund. It was helpful to the investors, and it allowed them to invest their money and have some instant diversification across properties, across markets. And the primary thing in the space is a blind pool fund, where you vet your syndicator up front. You decide these people are right for me, they're not right for me. You find the person that gels with you most, that you trust the most, and you turn over your 50, 100, 200, whatever it is, and their business plan might be, we're going to go out and get 4 to 7 properties. Well, you don't know what those properties are ahead of time. And I can tell you, I was a passive investor many years ago in a fund, and I really believed in the concept. But the problem is that they were going out and they were buying these great properties, and then one day they tell me, "Hey, we just bought 2 properties in a Rust Belt state," and all the alarm bells start going off. It's like, well, why would you be buying in a state that I know has declining population, I know has it has high unemployment? What's going on? So, I called the company, and I talked to a guy who probably shouldn't have told me what he told me, but he said, "Hey, we bought this from an associate of ours that we've done business with for many years, and they needed to get liquid on their balance sheet. So we did it as a favor to them." Well, it's like, you have a fiduciary responsibility to me and all the other investors in this deal. And they said, "Don't worry, we're going to make a profit on it." Well, when it was all said and done, those properties were the only properties that broke even. Everything else made money, but those broke even, luckily. But that's when I started to realize that as good as the blind pool fund can be, there are flaws in that. There are. And so when I learned about the customizable fund, that where an investor can trust but verify, and has the opportunity to see they're in the fund, but they can decide to opt out of a deal if they want to. Uh, uh, for me, even though that's harder as a fund manager, it's better for the investor. So I think
Mhm.
it's a better thing, and it's definitely something that I wanted to bring to my community.
Yeah, and it falls right in line with your fiduciary responsibility, right? Putting their best interest ahead of your own,
Right.
right? Maybe it is harder on you, but with some of these platforms that are out there, there's technology that can help make the management of the fund a lot easier and much more transparent, and a lot more reporting, and just way more ease of operations, so that
Absolutely.
there's not as much administration on you as a fund manager, which allows you
Absolutely.
to really stay true to your investment thesis.
Yep. Absolutely. Absolutely.
So what is your investment thesis for your fund? What do you guys like to invest in? Do you have certain markets that you like? Is it equity, debt? What are you focusing on?
We're operators, so we go out and we buy anywhere from 80 to 200 multifamily unit properties. We like uh, A and B grade properties. We tend to go in markets that have high population growth, a lot of jobs, diversification of job centers. The landlord tenant laws are at least neutral, if not favorable. Several things like that. We buy garden style 2-3 story properties. And we're looking to hold for a minimum of 5 years. It certainly wouldn't kill us if 10 years. And we're doing mostly value add and core plus
Mhm.
invest. So
What does
that's
core plus mean?
core plus is typically with a core property. You're in like a top market, something that's just been built. There's really no problems. You're in an ideal sub market. Core plus. I'm sorry. I apologize. Uh, a core plus property would be something where you're still similar to that, but there's something wrong. Maybe you have a vacancy. Maybe you lost your anchor tenant. Maybe some of the units are down. Maybe there's a fire and one of the buildings is down. When you
Hmm.
get back to where it needs to be, you're basically operating a core property. But it's just one level lower. And so it's a little more risk than core plus, but it's still still, I mean, ultimately, when you're investing in multifamily, you're investing in a roof over a person's head. So it's not
Mhm.
like it's going to go away. It, but it's less risky than, say, value add.
Right. And less capital intensive as well. You don't have to borrow as much or raise as much.
Borrow as much. You don't have to have as big of reserves. You're not a lot of that kind of stuff. So
Yeah,
and
and that's where like your experience comes in, right? Because value add is most value add is fairly straightforward, right? You just find stuff to fix and then maybe it's management. But with
right.
these other scenarios you're describing, it could be more subtle and more strategic in how you're adding value to the property that maybe is outside the box.
Yeah, yeah, and we're in a lot of southern markets right now, and the southern markets have been depressed. They've dumped a lot of product on the southern markets. Now, if you look out ahead, there's not a lot of permits being pulled for new product, and so we believe that that's going to slow down in the next year, and then there won't be a lot of new supply online for several years. But because it's been depressed, and because it's more in a recessionary environment, maybe into an early recovery environment, you're buying it where cap rates have gone up 120 to 150 basis points. And we feel like if you look at the real estate investing cycle, the recovery and expansion phases tend to be much longer, historically speaking, than the hyper supply and the recessionary phases. And so, I'm not a big believer in timing markets, but if the timing works out well for you, why wouldn't you buy now towards a dip in the market and ride a long wave of expansion?
Oh, yeah. I mean, you don't want to be a speculator, but you certainly want to track trends, right?
Exactly.
And try to catch them when you can. And with the availability of data now and the ability for to crunch that data, make it meaningful, like you would be, it would be a bad decision to ignore it,
I
right?
agree. I
And
agree.
having that data driven approach can make a big difference. And it's kind of a buzzword too, right? For, oh, we're data driven, but are you not you, but are you really, like, when companies talk about data or AI, are they really using it, or is it just a marketing ploy? But it
Right.
seems to me that you guys are really leveraging the data out there to make good decisions.
Absolutely. Absolutely. It's the only way to run this business. You can't, there's investors and even the people they invest with bring their own biases into the game. And the best way to not get caught up in those is to rely on the data, to have a systematic approach and rely on the data to know what you're doing. And too many, when you go out, let's say you get a property under contract and you go out to do your due diligence. Too many people, too many syndicators even look fall into the confirmation bias, where they're looking for reasons why to buy this property, and really you should be going out doing your due diligence, looking for reasons why not to buy the property.
Oh yeah. Yeah, it's just a great approach, right? If you err on this side of being conservative and you can still find deals, and you're way better off than if you just took a
Absolutely.
deal because you needed to. And I think a lot of companies do that because they don't have enough deal flow. And so
Exactly
they're
right.
when they get an opportunity, they're just trying to figure out, okay, we can make this work, instead of, being extremely conservative and really thinking about their investors too, right? Like, we don't just want a deal for the sake of having a deal. We want to make sure we're giving our investors the best return on investment over time so that they keep investing with us. Because all it
Right.
takes is one bad experience with an LP for them to completely lose trust in you and everything that you
Absolutely.
bring them from that point moving forward.
Absolutely. I can't tell you how many other syndicators that I've listened to who are in markets that were just when hyper supply hit and things were overpriced and cap rates were ridiculously low. We're saying, you know what, we're pausing our acquisitions. We don't need to acquire anything. We don't see anything in our markets that's worth investing. And yet, I also saw other companies that were like still picking up properties, and you'd see when they put out their when they would put out in their prospectus or in their PPM, their expected cash flow would be lower and lower and lower and lower. And I suspect, not that they would tell you, but I suspect that what was going on there is that they were expense heavy, and they had to churn. They had to sell properties and buy properties for acquisition fees and disposition fees to keep their operations going.
Yeah.
And you hear, oh, some of these people are now talking about selling properties. Well, when the cap rates have gone up, 120 to 150 basis points, you start, and the interest rates are as high as they are, you think, well, it's not really a great time to be selling. Why are you selling? And again, you wonder if, are they operating in the red and they just need to churn for fees, or what's going on there?
Yeah. Yeah. So many different angles, which, I've heard companies that their goal is to, double people's money in the first, in 3 to 5 years and then exit and do it again. And then, but you are saying that you might even like to stay in properties for up to 10 years.
Yeah.
But if you got good
Yeah.
cap rates, why wouldn't you?
Why wouldn't you? And if you're spending on appropriate cash flow, why wouldn't you? It's not that we wouldn't sell if there's somebody, and there have been times in markets where I've seen it where when we would get an outside offer, like I can remember we had a deal in Louisville, Kentucky, and we were operating the property. It was great. There was no issues with it. And then we get a phone call one day, and it's like, hey, we've got 4 C grade properties in this market, and you have a B grade property. It's kind of in the middle of all of ours, and we kind of want to cross market between. So if we've got somebody that has enough money that it makes sense for them to be in a B grade with the higher rents, we want to be able to tell them about that. And if we get somebody comes into that B grade property that really can't afford it, we want to send them to one of our C grade properties. So, and we're like, hey, it's not for sale. And well, how about for this price? And then when you go back to your underwrite and you look and say, well, shoot, I didn't expect that property is going to be worth that until 7 years from now. Well, at that point, then you have to make a decision. Am I doing what's best for the investor or not? Because maybe it's better to take that money now, do a 1031 exchange, and get them a better return. It's deal specific, but you definitely would look for that kind of offer. But if it's operating well and if it's hitting its numbers, not in any hurry to sell, that's for sure.
Yeah. So you found this really interesting niche working with medical professionals. Are there additional challenges that come with working with people who have that analytical mind and that, are used to working off of checklists and really being data driven? Is there additional challenges there, or is it all positive?
I think it depends on your mindset. For me, it's all positive. I had to get out of medicine. I haven't met a ton of people who have to get out of medicine. I've met a lot of doctors who need to cut back, who need to work less, who need to feel more secure. And so I didn't start out I started out to take care of my family, my wife, and I felt like it was a blessing to be able to help these other people. They were asking me, they had a similar desire, a similar experience in medicine, and they wanted to develop passive income. And so it was awesome for me to be able to help them. And yeah, some of these people are very analytical, but I don't take the approach of I'm trying to convince you. I mean, if you're investing in properties for 5 to 10 years, this isn't a one night stand. This is a marriage. And so I'm not trying to convince anybody of anything. It's like, this is my investment thesis. This is what I'm trying to do. This is my track record. Here's the information I have about this asset class. If it's right for you, great. If it's not right for you, feel free to call me anytime. If I can help you find something else, if I know about something else, I'm happy to share that with you. I just look at it as sharing and helping my colleagues.
Yeah, I've always liked that approach where it's like you're almost doing someone a disservice if you don't give them the opportunity.
Right.
Right. But you really have to believe in your product, right? Like if you really believe in your product and you believe in your investment thesis and the numbers are true, right? Like you've went through those numbers with a fine tooth comb to make sure that that property or opportunity is going to be a good ROI, then you can confidently come out and earnestly say, this is an opportunity here. I believe in it. My own
Right.
money's in the deal, even, right?
Absolutely.
So if I don't tell you, I would feel bad.
Right.
That is a blessing.
Right. Too many other guys will chase money, and when you chase money, money runs. you're not coming at it from the right perspective. And I think that I believe in this asset class. I've been doing it a long time. And if somebody wants, this is what I'm doing. And if you want to come along and along this journey with me, great. If you don't, that's okay too.
Yeah. Do you work with fund to fund managers to raise money for
You know,
your opportunities as well?
the company I was with in the past I personally haven't yet. We're
Hmm.
open to it if we can make things work well. Uh, I've seen, now that I've been in the industry as long as I have, that I've seen a lot of things that I don't like about the industry. So
Mm.
I'm trying to, in my own way, trying to correct those in our fund. And so we're offering a fee structure that I think is definitely lower than the average fee structure in this industry, but I think it's quite attractive. And so I don't know what I'm still exploring and trying to figure out is with other fund managers, because they have to get paid as well. People have to
Yeah.
get paid for their expertise in what they're doing, is what we can offer them to make it a win-win for everybody. Um, so that's something that my business partner and I are still working out, is how many fund managers we can work with, and what can we structure to make it worth that fund manager's um, while, but still give the investors an exceptional deal.
Yeah. And also there's only so many deals to go around unless, deals are falling out of the sky. Like you want to give those best deals to the people who have already bought in to your group and they're part of, Nest Egg RX, and they're like
Right.
they've got money sitting on the sidelines. A lot of these people still have more money than there is opportunities.
Yeah. Yeah. And absolutely. And the other thing is, I mean, you see these things, it's hard for me to be critical, because as a physician, I was paid for my expertise, and as a fund manager, people should be paid for their expertise. Um, so I don't begrudge anybody making money, but I see these waterfalls where typically there's a 70-30 split, but and then they'll add another tier to the waterfall. Well, if we hit 14% return for you, then we're going to go to a 60-40 split or a 50-50 split. And if you model that out, the syndicator's making a lot of money on that deal. And again, if you're getting your investor a 14, 15, 20, 30% return, great for you. Who could begrudge that? It's just not the model I want to. I want to be straightforward. I want to. It's just not the way I want to operate.
Yeah. I've heard all different waterfall structures out there. Some of them are so complex I can't even understand them, because
Right.
you're right, there's different tiers and there's escalation clauses, and there's all these things. It can get pretty complicated, and it just makes it more difficult to explain to your investor. They're like, "What's all this stuff?" Right?
Absolutely.
So if you
And
make it more complicated, it's gonna people get analysis paralysis, and when people don't know the answer, it's just easier to say no.
right. And even if they say yes, but they don't understand it, when the property comes full cycle and the split happens, then they're unhappy because they didn't expect. Well, I didn't understand that to be. Well, you misunderstood it, and you're not getting as much as you thought, and I mean, you can make it complex. There's no doubt you can, but it's not the way I want to operate my business.
So is that one of those things that you said you don't like about the industry, is these complicated waterfall structures, or are there other things that you think we can improve upon as an industry?
Well, it's I focus on transparency, fee structure, and flexibility. And I absolutely think those things can all be improved. I mean, there are so many things that people don't understand. Because I'm in the industry, my Facebook feed is just riddled with ads from companies, and I think also because I'm a physician, and a lot of companies will target physicians, and I'll see things like. Uh, 2x, 3x your money, 25% average annual returns and it's like, well, wait a second. Can people hit 25%? Absolutely, they can hit 25%. We've hit 25% before, but we've never advertised 25% because when we underwrite it, we don't underwrite it to that. And uh, what typically happens when that works is we've operated the property well, but we also benefited from the fact that we were in an expansion phase of the market where cap rates were declining, and that cap rate compression helped us hit a home run. But to advertise to somebody, uh, that's not typical. I know that that's not typical in the market, and so it's almost like they're trying to appeal to a person's greed or to induce them to invest. And I mean, even new construction, which is the riskiest in our business, doesn't generally historically on average hit 25% annualized return. So I see these things and I think it's misleading. I also noticed that when a person goes to a new syndicator, they will tell them the average annualized return, but they don't necessarily open up the spreadsheet and show it to them. Not that everybody wants to see that. A lot of people don't, but some people do. It's like, how did you get there? Because there's a lot of assumptions that are being made. And why not open your spreadsheet and show the investor those assumptions? And why did you make that assumption? Well, I talked to X, Y, or Z, and here's 5 competitive properties that when they added these amenities, they're getting this rent, and this is how I can justify in my value add plan that I'm getting to that, because I've been to the market and I've walked those other competitors, and I've done the survey to see what kind of rents you can get in that market. Well,
Mhm.
a lot of companies don't do that. They make those assumptions, and when you get into their spreadsheet, a lot of times what you find to get those really high numbers is that they bought the property at an entry cap of whatever it is, and they're assuming an exit cap far lower. Well, nobody has a cap rate crystal ball that tells them 5 years from now, 7 years from now, the cap rate is going to be 150 basis points lower, 200 basis points lower, but that's how they're underwriting it.
Mm.
Maybe they'll get it, and if they do, great. But to me, it's misleading.
Have you heard of the FTC being involved in making sort of these outrageous marketing claims? Um, there's some industries where the FTC is really cracking down on, making marketing claims and assurances. Have you seen that in this space?
I have not. No, I haven't.
Mm.
You see stuff like failure to blue sky filings failure, and then of course out and out fraud. But I haven't seen that. Um, yeah. So I
Well, the
mean,
PPM has so many disclosures in it, right? Of
oh,
like
yeah,
outright loss. Like
right,
you're probably going to lose your money, is like what it says, right?
right. You're probably going to lose your mind. You shouldn't do this. I don't agree with that, but the lawyers absolutely has to be there.
Yeah, those the whole legalese thing. Like it's surprised if really anybody invests, but
Right.
people do because of the positive things that have happened, and people are making money. So they could go with something more safe, or quote unquote safe, like the stock market, right? Where even that is extremely volatile. We've seen the market go up and down. All one news release because Deep Seek released a new AI model, and the stock market takes a tumble, and certain companies operating in that tech space lost huge market caps, and it's extremely volatile, and real estate isn't typically like that.
No, no, it's not. I, and if you look at a lot of the research that's been done over the last 20 to 30 years, if you took the what used to be the norm, it's not so much now, as the balanced portfolio, 60% stocks, 40% balance bonds, and you add commercial real estate to it, you increase your returns and you decrease your volatility. And so for a lot of people, it makes a lot of sense to add that to their portfolio. But you have to
Mhm.
run that through your risk tolerance and what you already own to make sure it's right for you. I can't make a blanket statement that something's right for everybody, because nothing's right for everybody. You just have
Yeah.
to run it through your own situation to see if it's right What I can do is I can provide people with research and data and numbers of why this asset class works. And, ultimately they have to decide if it's right for them or not.
Yeah. Is that part of your, you called it flexibility? Does that have anything to do with access to liquidity? Like if they get into a deal and something traumatic happens, right? Where they need access to their money. Do you put in any sort of way for people can to access it in extreme situations?
In the past, we've done it where, and you have to be really careful because you can't set yourself up as a broker dealer or somebody who's
Right.
who's selling securities,
Hmm.
because that's a no. But what you can do is and we have done in the past is when we were with another company, was we've said, hey, so and so wants to sell their portion. This is what they're requesting for. If you'd like to buy from them, please contact him. Here's their contact information. And that wouldn't go out publicly. That would go out to all the other people within the deal.
Yeah.
But there's no doubt real estate is illiquid. I think what I'm referring to more with the flexibility is that, if you're in a fund and it's a 5 or a 7 or a 10-year fund, and you go in initially before they buy any properties, you've committed to that fund, and it's highly illiquid, and uh, you better trust that syndicator that they're going to buy what they say they're going to buy. And I've been in scenarios where they didn't buy what they said they were going to buy.
Yeah.
And so that's why I really like the idea of a customizable fund, because it allows you to be in a fund, but you have to give a thumbs up on a deal by deal basis. You say, yeah, I'm in this fund, but I don't really like this property. So I'm going to not have my money in that. So my investment in the fund is going to be minus that property. And that really allows the investor to trust but verify, as opposed to the standard being the blind pool fund, where just people, once you're in, you're in, and what they get is what they get. And if you're a syndicator and you've got money sitting there and you're not finding good deals because the site, you're in a market cycle where your investment strategy doesn't work any longer, you either need to change your investment strategy or you need to sit on the sidelines until the cycle comes back to what you do works. Well, some syndicators will do that. Some won't. Some will be like, hey, I got to keep my lights on. I got to keep my doors. I got to keep my employees. So if I'm buying properties that get a 5 to 7% annual cash on cash return, and I'm targeting an overall 12 to 16% annualized return after we sell the property, and now the cap rates have gone so low that I can only squeeze 2 to 3% out of that. Well, I'm still going to buy it because I have to buy it to keep my operations running. Well, now that company is no longer, their interests are no longer aligned with the investor's interest.
Yeah.
And that's a problem.
Yeah. It is. And it's because there's so many people in this space now. Like it became kind of glamorous to be a fund manager and be an asset manager. And it's attracting a lot of people who don't have the expertise that, maybe they're good people in general, right? But
Sure.
they put themselves in these situations where they have to kind of keep the ball rolling,
Right.
but there's potentially negative consequences if they don't put their people, their investors first,
Right.
because they have the interest of their company and keeping things moving forward, ahead of the fiduciary responsibility to their investors.
Right. Right. And that's not out and out fraud, but it still hurts when you're not getting the checks that you expected to get. And when they sell the property and you said, man, I've been in this property for 10 years and I've got nothing of a return.
Yeah,
That's a problem.
it is. Man, this has been a great discussion. I think I could talk with you all day, Dennis. Um, but I'm sure there's some people who are interested in what you're working on. Maybe they're medical professionals, maybe they're not. You'll work with anybody.
Yes.
If somebody does want to work with you or just have a conversation, where can they go and find more info?
The best place to start is Nest Egg RX, which is www.nesteggrx.com. I have a calendar link on there. I'll talk to anybody. Anybody wants to, I get people that want to talk to me about their own real estate, and if I had any ideas, I'm happy to talk to anybody. This is what I do for a living, And even though real estate is a brick and mortar business, it's really a people business. So, I just think feel free to reach out to me. I'm happy to talk to anybody. Accredited, non-accredited, doesn't really matter.
Amazing. Well, thanks for spending some time with us. We really appreciate it. And for those of you who are listening, reach out to Dennis. You can see he's, a straight shooter. You can tell that he's gonna, work with you in a way that's going to help you get the best ROI, or at least just give you some information that you can take and just leave better educated than when you talked with Dennis. But keep an eye out for more exciting guests like Dennis here with future podcasts of the REI Hacker Podcast. We talk about business and entrepreneurship and real estate investing and all kinds of exciting things out there. So keep an eye out for that. Thanks for listening, and we'll see everybody next time. Take care.
Thanks, Benson.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.